Welcome to DWS Market Update. After the budget is before the budget. Just as the federal budget for Germany for 2025 has been finalized, negotiations for 2026 federal budget and the financial planning through 2029 are underway. All in all, significantly higher federal deficits are expected, not least because of massive investments in defense capabilities and infrastructure. But can the German economy really expect a boost from this? To assess this, economists use the concept of fiscal impulse. First, they calculate the primary balance, which is the budget balance minus interest payments. If this primary balance remains constant, there is no stimulus for the economy from the budget, even if new borrowing remains constant at, say, 2%. If new borrowing is increased, for example, to 3%, this represents a positive stimulus of 1% of GDP. If borrowing is reduced, the result is a negative impulse. Fiscal policy then puts the brakes on the economy. This is the case this year due to numerous special effects, with around 0.5% of GDP. Next year, however, we expect the deficit to rise to at least 3%, resulting in an impulse of at least 1% of GDP. This is a fiscal turnaround of 1.5% of GDP. There are widespread concerns that the bulk of the defense spending will go abroad and that German companies will benefit only to a limited extent. However, according to calculations by the Kiel Institute for the World Economy, the lion's share of defense contracts will go to German companies, or at least those with German participation. We therefore expect the German economy to grow by a good 1% in the coming year. What does this mean for investors? For European investors, the heavy overweighting of US equities due to the impressive performance of recent years has proved rather unfavorable this year. A key factor was the weakness of the US dollar. We expect the dollar weakness to continue. Therefore, increasing European stocks in portfolio seems attractive. However, we would also advise to stay invested in the US, given the current leadership role of its tech companies. But European stocks still have considerable room for catching up. With that, I say goodbye until next time.